The top business stories live from the Sky News City studio. An announcement is imminent on a support package for Tata Steel, but at a potential cost of thousands of jobs. Thousands of American car workers go on strike in what could prove a crucial moment for global auto manufacturing. Everton Football Club is to be bought by the Miami-based investor 777 Partners. Good morning, this is Business Life with me, Ian King. We begin with news on the future of Tata Steel and the Port Talbot plant in South Wales. In the last few minutes, the government has announced a support package to secure the plant's future. It's thought it could lead to as many as 3,000 job losses. Well, joining me now is our business correspondent, Paul Kelso. Paul, what's the latest?
Expecting imminent confirmation from government of a investment of £500 million in Tata's steelworks at Port Talbot, a deal that Sky News has been reporting for the last fortnight, expecting it to be formally confirmed by the government. We wait to see if they'll put a number on the subsidy that's going in. Tata have confirmed it already. The chairman of Tata, the Indian industrial conglomerate that owns the steelworks, has described it as a defining moment for the future of the steel industry. The proposed investment will preserve employment and represents a great opportunity for green technology in Wales. On the issue of employment, it is thought that despite this injection, which will convert the plant from coal-fired furnaces to electric arc furnaces, green, cleaner, but not as hot, so they can't produce the same brand of steel, the same grade of steel. It's expected to, in the long term, cost around 3,000 jobs from Tata's 8,000 strong workforce. As a consequence, the unions, far from welcoming this injection, have panned it. They say they've not been properly consulted. The GMB is saying it will rip the heart out of Port Talbot by losing those jobs. Very interesting, this deal comes at the end of a week which began with Kemi Badenoch, the business secretary, writing a cheque for £75 million to BMW for electric vehicles, minis, to be made in Oxford. There's been a bit of a splurge of subsidy from the government in the last year. Tata, of course, has already received thick end of £500 million to sweeten a deal to build a gigafactory in Somerset to aid that move to EV production and the general net zero process. At the same time, we've seen a wind farm auction fail and we've got doubt over HS2. So while the business secretary is writing a lot of cheques, the most recent one, the one that will be confirmed today around steel production, there's no clear industrial strategy here, and it does seem that the foreign companies that are behind most of the investment in key industries in the UK are getting quite a good deal out of the taxpayer.
Paul, thanks for that. Well, joining me now is Gareth Stacey, Director General of UK Steel, the main industry body. Gareth, welcome to you. As Paul said, the taxpayer handing over up to £500 million here. What are we going to get for our money?
Well, what I want to say, first of all, is this is a really important day for the steel sector in the UK, with government showing its firm and bold commitment to the future of steel making here in the UK. And what is it going to get for its money, Ian, you asked me? Well, a truly transformation of our sector to produce steel for the net zero economy, net zero steel, which our customers are asking us for. And so therefore, we have the ability to completely transform our sector to boost the net zero economy in the UK, deliver on our customers' needs, but also to really seize the opportunity of increasing production in the UK, increasing exports, reducing imports, because we all know that a net zero economy needs more steel, not less.
Now, according to the Financial Times, Tata Steel was originally looking for billions in subsidies. The fact that they've settled for less than £500 million, I mean, rather suggests that they don't really need that much support at all and that they were just sort of trying to shake the government for a bit of money.
Well, any taxpayer's money needs to be well spent. And so therefore, this is about a partnership. It's not about a partnership with one announcement today. It's a long-term partnership with all companies in the steel sector, with government. That's what we want to see. A year ago, we published our net zero roadmap, our ambition for the whole sector, not just one company, the whole sector, to get to net zero. We partnership with government to deliver that, the detail of that. And that's what today's announcement for the whole sector is all about. It's about the government understanding the scale of investment that we need. If we look at the UK capacity in blast furnace at the moment, it's something like 9 million tonnes. To transform that to electric arc furnace, for example, would cost a whopping £3.6 billion. So this is the start of investment for our sector, not the start and finish today. And that's why today is so important.
We've just had official confirmation, Gareth, from Tata Steel. They're going to be investing £1.25 billion, 500 million of which will be coming from the UK government. I mean, the UK steel industry, it's not very clear that it actually has a competitive advantage anymore. Some people would ask, do we actually even need a steel industry in this country?
Well, competitiveness is crucial. We need the investment to transform, so we need the capex, and then crucially, without OPEX, as in without having a competitive business landscape in the UK for a steel company to be able to compete in a global market. 43% of all steel produced outside China travels across borders. It's highly traded, and therefore we have to be as competitive as we can be to be able to compete in our home market in Europe and globally. But the opportunities are there. Global demand for steel is increasing, and therefore we in the UK can now move forward, become more competitive, make that investment and deliver on that opportunity.
Some people would say, though, this is an industry that's always got its hand out. I mean, if you take, for example, Credit Suisse, big investment bank in the Canary Wharf, they're laying off thousands of people who probably earn a good deal more than the average steel worker. I've seen no special pleading for them for subsidies. What is it about steel that turns ministers' heads?
This is not about special pleading. This is about steel sectors right across the globe working with their governments in partnership. We've seen it in other countries, in France and Germany, in Canada, in the US. No steel company anywhere in the world, sorry, not steel company, no steel sector anywhere in the world can make that transition from high carbon to low carbon net zero without significant co-investment from government. It's not happening anywhere else in the world, and I'm glad that today marks that start of the partnership here with industry and government to get to net zero. That's our ambition. That's what we published a year ago.
All right, Gareth, busy day for you. We do appreciate you spending the time to chat today. Thank you. Now, a massive story has broken overnight on the other side of the Atlantic because thousands of car workers at the big three Detroit-based car makers, Ford, General Motors and Stellantis, went on strike shortly after midnight in one of the industry's biggest pay disputes in decades. Some 12,700 members of the United Auto Workers Union joined picket lines in targeted stoppages at Michigan, Ohio and Missouri after the union failed to agree terms with the car makers. It's the first time that the union, which has 389,000 members, has staged strikes at all three companies at once in its 88-year history. Well, joining me now is Peter Campbell. He's the global motor industry correspondent for the Financial Times. Peter, good to see you this morning. I mean, this is really quite a seismic dispute, even by the standards of this industry.
Well, that's right, Ian. Good morning. Well, every 4 years, the UAW, the United Auto Workers Union, holds pay talks with Ford, General Motors and Stellantis, and they're always robust. But this year's have been unusually contentious and confrontational. That's for a couple of reasons. First of all, the union itself went through a bribery scandal a few years ago, and the new leadership are wanting to show off that they're very tough to their members. But the much bigger issue is that they are really, really concerned about the shift to electric vehicles. Electric vehicles take much fewer workers to assemble. They have much fewer moving parts. And typically in the US, some of those vehicles tend to be made in ununionized plants. Now, the US still has a very small percentage of EV sales, but we know the direction the industry is moving in. Electric vehicles are going to be sold everywhere and are going to be incredibly prevalent over the next few years. And what the UAW is trying to do here is to send a message to the big three that they want to be part of that and they want to be protected in that transition.
And their tactics are very interesting here, Peter, aren't they? Because normally they single out one of the big three and just concentrate their fire on them. But they're going for all three this time. Why is that?
Yes, if you remember, 4 years ago, they went on strike at General Motors for about 6 weeks before GM before GM folded to some of their demands. So here they're worried about the whole industry transition, and rather than singling out one car maker and making it just about them, they want to send a message to the whole of the sector. And what they're doing is a slightly different tactic. It's where they don't say they're going to target every plant, but they don't tell the car makers which plants they're going to target. So at any given day, the car makers could think that their plant is going to make cars, and the workers will just stand up and walk out. That is designed to be very disruptive, but it is also designed to mean the strike can last for longer. Now, the auto union has almost 800 million in its war chest to help pay striking workers, but that money isn't going to last forever if it tries to target every plant. So by targeting individual plants sporadically, they're able to cause huge disruption to the car companies themselves, as well as trying to make their funds last for as long as they possibly can. Now, the car companies offered them a 20% pay rise. The union asked for 36% pay rise. Talks broke down, as you said, at midnight in Detroit last night, which was 5 a.m. London time. But the car companies also have a lot of cash on their balance sheets. They're able to weather a strike that goes on for several weeks, and the union is digging in as well. And so it looks like this could last for some time.
We know that Joe Biden's very worried about this. He's rung apparently the CEOs of all the three car makers. I mean, this does have implications for wider manufacturing in America, doesn't it?
Yes, I mean, Joe Biden has made manufacturing in America a huge part of his presidency, particularly with the Inflation Reduction Act, which is supposed to try and bring electric vehicle manufacturing and battery manufacturing into the US. Now, that has been a hugely disruptive global policy. It has had ramifications in Europe and China and everywhere. But the UAW, the union for the car workers, is still incredibly worried about this shift, because while it's good that those cars are going to be made in America, if those workers are not unionized and if they're paid less, then that is an issue for the union. And also, let's not forget that it takes much, much fewer workers to take them. Ford estimates something like 40% fewer workers are needed to make an electric vehicle compared to making a combustion engine vehicle. And that's before you even get to the disruption that's going on with engines. Engines take thousands of moving parts that have huge complex supply chains that sprawl throughout the US and Mexico and across the world. And EVs are much, much simpler and take a fraction of the moving parts. So there's huge industrial disruption that's going to be caused by the shift to electric vehicles. What the union here is doing is saying that it's not going to go down that road without a very big fight.
Peter, you touched just now on the fact that a lot of EV car makers are ununionised. I mean, it seems to me the big winners from this are going to be Tesla and potentially the likes of Toyota in America, who are also ununionised.
So all of the car makers in America will have to comply with US electric vehicle kind of sales targets, which the federal government is talking about. Tesla is not unionized. That has been a huge source of contention, particularly in the administration, and is why Elon Musk sometimes thinks that he's been ignored by Biden, despite actually being the biggest electric car manufacturer and seller in America. It certainly is going to benefit some of those that aren't unionized, but ultimately the biggest winners globally in the shift to electric cars are going to be the Chinese. Now, America is trying to protect its economy from some of them through the Inflation Reduction Act. In Europe, in the last couple of days, we've seen a huge shift with the EU trying to launch a probe into China that will try and stop them or try and curtail the sale of Chinese electric vehicles here in Europe. But Europe and Detroit are world leaders in engine manufacturing, and China is a world leader in battery manufacturing. And so it's pretty clear across the world that the shift to electric vehicles is going to hand a huge amount of power and influence to China in the future. And that has been one of the big drivers of Biden's industrial policies, and now in the last couple of days, the EU's industrial policy that we've seen as well.
All right, Peter, got to leave it there. Good to see you this morning. Thank you.
Pleasure. Thank you, Ian.
Some other stories for you now. It's breaking news, and in the last hour, a takeover of Everton Football Club has been announced. Farhad Mashiri, the Anglo-Iranian businessman who's been Everton's majority shareholder since 2018, has agreed to sell his 94.1% stake in the club to 777 Partners, a private Miami-based investment group which owns a number of other football clubs around the world. These include Genoa in Italy, Vasco da Gama in Brazil, Hertha Berlin in Germany, and Standard Liège in Belgium. No price has been disclosed in the sale, but Sky Sports News is suggesting it's £550 million. Shares of Games Workshop surged by as much as 11% this morning after the miniature wargaming company said trading during the last 3 months had been better than expected, and it unexpectedly announced an extra dividend payment. The Nottingham-based company said sales in the 3 months to the 27th of August came in at £121 million. That was up 14% on the same period last year. It said pre-tax profits for the quarter would be an estimated £57 million, up 46% on a year ago. The company said the 50p a share dividend declared today was in line with its policy of distributing what it referred to as truly surplus cash. The bootmaker Dr. Martens is to launch a shoe repair service in Britain next month, it revealed today. Kenny Wilson, the chief executive, said the aim was to boost the company's sustainability credentials, encourage customers to extend the life of their boots and create a new revenue stream. Mr. Wilson admitted the new repair service might stop some customers from replacing their boots with a new pair, but insisted that longer term it would boost customer loyalty. The company expects to charge £81 to replace a pair of worn-out soles, which is less than half the price of a new pair of boots. Bit of breaking news to bring you. We're going to get some comments now from Rishi Sunak, the Prime Minister, on this Tata Steel subsidy. Here we go. I apologise. He's not talking about Tata Steel. He's talking about the American XL bully dog, which the Prime Minister has just said will be banned by the end of the year following a series of attacks. Rishi Sunak has been speaking on that this morning. Here's what he's got to say.
The American XL bully dog is a danger to our communities, particularly our children. I share the nation's horror at the recent videos we've all seen. Yesterday, we saw another suspected XL bully dog attack, which has tragically led to a fatality. It's clear this is not about a handful of badly trained dogs. It's a pattern of behaviour, and it cannot go on. While owners already have a responsibility to keep their dogs under control, I want to reassure people that we are urgently working on ways to stop these attacks and protect the public. Today, I have tasked ministers to bring together police and experts to firstly define the breed of dog behind these attacks, with a view to then outlawing it. It is not currently a breed defined in law, so this vital first step must happen fast. We will then ban the breed under the Dangerous Dogs Act, and new laws will be in place by the end of the year. These dogs are dangerous. I want to reassure the public that we will take all necessary steps to keep people safe.
Well, there you go. That's Rishi Sunak saying that the American XL bully dog is to be banned. Of course, as he said there, it isn't genetically defined as a breed right now, so I suspect the genetic testers are going to be kept very busy by that announcement. Well, still to come here on Business Live, we'll have a look at how the markets are doing this Friday morning. Don't go away. An enormous explosion has just come down.
I'm Stuart Ramsey, and I'm Sky's chief correspondent.
You either live and recover, or you die.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Well, Wall Street enjoyed a solid finish last night, inspired by a triumphant return to the market for ARM Holdings. The British chip designer shares rose by 8.2% on its debut on Nasdaq, giving it a valuation of $65 billion. Well, that was followed by a largely positive session overnight in the Asia-Pacific region. Only Shanghai of the region's major indices finished in negative territory. Right now in Europe, stocks are also heading into the weekend on an upbeat note. All the main continental European indices up right now. Talking points today include H&M, the world's second biggest fashion retailer. Its shares are off nearly 5% in Stockholm after quarterly sales came in below expectations. Here in London, the FTSE's hit a 3-month high this morning, currently trading 0.4% higher. Consumer stocks are leading the way, but it is a broad-based rally. In terms of percentages, the leading gainer right now is Flutter Entertainment, the owner of Paddy Power and Betfair. Its shares are ahead a couple of percentage points, benefiting from broker support. B&M European retailers ahead by 2.5% for similar reasons. Outside the FTSE 100, the commercial property company Great Portland Estates is up. That's had a push from one of the brokers today, up at 1.5%, I think, right now. EasyJet, meanwhile, continued to benefit from growing optimism around travel. Wizz Air was up by a similar amount earlier on as well. That seems to have dipped into negative territory as well. On the foreign exchange markets, well, earlier on today, the euro was still on the back foot after yesterday's comments from the central bank. But as you can see, the single currency currently is ahead against both the US dollar and sterling, although that said, it is still heading for its 9th straight week of declines, which is the worst run since it was created in 1999. As for the oil price, well, that continues to hit fresh 10-month highs on expectation of growing demand from China. A barrel of Brent crude earlier on today hit $94.63 a barrel. That was last seen on 16th of November last year. And as you can see, it's not far off that now. $93.99 a barrel is the current price, up a third of 1%. Well, joining me today is Sophie Lund-Yates. He leads equity analyst at Hargreaves Lansdown. Sophie, great to see you this morning. ARM Holdings, big success overnight.
Hi, good morning. Yes, ARM, obviously we can't not talk about that when we're looking at the markets this week. So they had their IPO, they traded their shares, or a chunk of their shares for the first time publicly yesterday, and they popped 25% on what was already arguably quite a frothy valuation. So this has been just enormous moves, really. And me, with my analyst hat on, I am starting to look at, yes, OK, this is great to see in terms of some excitement coming back to the equity markets and what this might mean for a future slate of IPOs. But really, we need to be looking at valuation, because at the moment, that, for me, is now looking really quite toppy. And that will be something that I'm monitoring from here.
Absolutely. I mean, even at the offer price, it was valued at 100 times earnings. I mean, who is paying for this and why?
Yeah, so it's exceeded actually Nvidia now when you look at this on kind of a 12-month basis. And really what we've seen is a lot of retail investors in particular, they're just incredibly excited about the potential here, because there is a way, quite a big way, to be honest, where ARM is benefiting and able to benefit from the huge mushrooming demand and excitement around AI. But not to be overly negative, there's obviously a lot of potential there. Its technology is also very much geared towards the consumer side of things. So most smartphones will be using ARM technology, things like that. They are a lot more exposed to the consumer and electronics angle, which is kind of on a very different trajectory compared to AI. So that is something really, as we see consumer confidence maybe unwind, given the tough economic conditions, that is something that will need to be watched really closely.
Absolutely. Now, what about the oil price? I mean, good news if you're an oil producer, I guess, but not so good news for the inflationary outlook.
No, definitely not. You were talking just then, you know, Brent is around the $94 a barrel mark. That is huge. And not only that, but people are starting to bring up the mention of $100 a barrel being possible again. This is not what policymakers or consumers, for that matter, want to see. Fuel it's an enormous input into overall inflation. So if we keep seeing the fuel price or the oil price rising this sharply, that does raise some serious question marks. And essentially what we're seeing is that the main kind of production cartels are limiting supply at the moment at a time when demand is increasing, particularly in China and the US, where the economic situation is actually not as tough as we were first thinking.
And briefly, Sophie, a story that caught your eye yesterday. Not a quoted company, but Lidl's UK arm made a big loss last year. And that has implications for elsewhere.
Yes, definitely. This is something that, the UK's got some big grocers, so it's important to look at Lidl, even though it's not necessarily listed. So, Lidl, they've reported a £76 million loss last year, and that is because they are investing in keeping prices low while also chasing expansion, and they're facing inflation. And the reason this is important, it tells you that as much as people are funneling themselves towards cheaper options at the supermarket, it is not a golden ticket to keeping margins propped up. So that is something that I think, again, needs to be watched and is a really important one to keep hold of.
All right, Sophie, got to leave it there. Great to see you this morning. Thanks. You. That's it from me for now. I'm back at 4:30 with our afternoon edition. Do stay tuned for that, because we've got a fantastic interview with one of the world's biggest diamond producers. You don't want to miss that. Stay tuned. See you later. Cheerio.